On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. All right, another week has wrapped up and another one is about to start. So let's look back at some of the key events and market developments of the last several days and take a look ahead to see what we should be keeping an eye on over the next few days. World share markets remained in a pretty upbeat mood last week. We had the S&P 500 in the US rising another 0.7%. The Dow Jones Industrial Average was up, or has been up 10 days in a row now. So it's on its best winning streak since 2017. And you still have got a fairly positive tone out there. Investors are very much getting more comfortable about the inflationary outlook, particularly in places like the United States. There's a feeling that the end of the interest rate hikes is within sight. And we've managed to get to that point without the US economy really stumbling too much. We've also obviously had the tech sector, which has enjoyed a very strong run with all the excitement over AI, which has driven up the price of many of those really exciting growth companies, the Nvidias, the Microsofts, and so on. So it's been a pretty buoyant period. It wasn't just the US that was strong. We had the European markets up 1% last week. And the FTSE 100 in the UK, actually one of the stronger markets around the world, that index surged 3.1% for the week. And I think that largely came on the back of a lower than expected inflation report out of the UK for June. And when I say lower than expected, we're still talking about a very high number. It was 7.9% per annum that we saw inflation rise in June, which is still horrendously high. But it's down from, I think, 8.7, and that was below forecasts for 8.3. So it's more a case of the progress that's being made relative to where people thought the inflation rate would be at, rather than it actually being at a level where we should be at all comfortable. So that's how global markets were tracking. In this part of the world, things are a bit more subdued. We had the Aussie market, the ASX 200 up ever so slightly, just 0.2%, so not nearly as strong as some of those international markets. And the local NZX 50, which does often buck the trend for a range of reasons, we actually fell slightly. So our market was down 0.6%. It's still been okay this year. It's up 4% year to date. So it's performed better than some markets, but it certainly hasn't risen anywhere near as much the likes of the US or even Europe or Japan. All of those markets have been much stronger. In terms of interest rates, in the US, we saw shorter term interest rates up slightly. So the US 2-year Treasury yield up not much really. It finished at sort of 4.8, but it was, just slightly less than that a week earlier. So the moves weren't substantial. The 10-year yield was fairly much unchanged at 3.8%. So up slightly at the shorter end, but longer term interest rates, not a lot of movement there. Here in New Zealand, we saw the 5-year swap rate rise slightly. So it finished the week at 4.8%. That came on the back of a slightly hotter than expected inflation report, which I'll talk about soon. Bonds have still performed quite well this year. As I just said, the NZX 50 is up 4.1% year to date, and the corporate bond index is up 2.9% so far this year. So that's still gains from both those two main asset classes in the local market, which will be pleasing for investors after both of those were down last year. In 2022, you had the NZX 50 down 12 or 12.5%. And you had corporate bonds, or at least that NZX corporate bond index, down about 5%. So both up after having had a difficult previous year. Some of the key events that we saw out there in the world, one of the key releases was Chinese GDP, which came early in the week, and this was pretty soft, really, a little disappointing for the June quarter. GDP up 0.8%, which was in line with expectations, but down from 2.2% in the March quarter, and the annual pace of economic growth rose to 6.3%, which was ahead of what we saw last time, and actually the highest in about 2 years, but it was below forecasts for just over 7%. So okay, but just a little on the soft side. June activity indicators for the month of June weren't particularly inspiring either, in terms of just what they might mean for any short-term improvement out of China. Industrial production looked okay, that beat expectations, but you've still got a property sector that's got all sorts of issues, and retail sales were a bit disappointing as well. The key release here was obviously the inflation report. So we got that CPI report last Wednesday, I think it was. This is for the June 2023 quarter. So good news and bad news. The good news is that at the headline level, the CPI rose 1.1% for the quarter. So that's down from the previous quarter. And that's actually the lowest we've seen since March 2021. So the annual inflation rate slowed to 6.0%. So the positive there is that not only is that down from the 32-year high of 7.3 a year ago, but it's also the lowest in about 18 months, and it was below Reserve Bank forecast. So they were picking 6.1, came in at 6.0. That was probably the end of the good news, because when you look under the hood and when you look at the detail, much less encouraging. The key reason that, even though that was lower than Reserve Bank forecasts and the lowest in a year and a half, the key reason there was a bit of disappointment out there is that most of the decline came from a fall in tradables inflation. And tradables inflation is the prices of everything sort of imported, everything international. It's the impact of sort of lower oil prices, maybe a higher currency, those sorts of things. And the domestic based inflation, which is what they call non-tradables inflation, that was much stronger than expected. It didn't come down nearly as much. So that tradables inflation, the Reserve Bank was expecting that to slow to an annual rate of 5.8, and it actually slowed to 5.2. So that's what dragged the headline down. But when you look at the non-tradables inflation, that came in quite strong for the quarter, and the annual rate of non-tradables inflation, that only came down to 6.6, and that's not that much lower than 6.8 from a quarter ago, and 6.6 is quite a bit ahead of what the Reserve Bank was picking. They were picking 6.3. So in short, in aggregate, inflation's come down, and that's good. It's a little lower than the Reserve Bank was expecting, but it's come down for the wrong reasons. And those domestic inflation pressures, those New Zealand-based ones, things like housing costs, things like rents, all of those sorts of things, food prices, they were up really strongly. Those are the ones that often prove more difficult to get under control. So they tend to be stickier, and they do tend to hang around for longer and be a bit more persistent and structural. So that won't have pleased the Reserve Bank. And on balance, it's probably a little stronger than we were hoping for, and certainly what the Reserve Bank would have been hoping for. So what does that mean for the OCR? Well, the next Reserve Bank decision is scheduled for the middle of August. So it's sort of 3 weeks away. And at that time, we'll also get a fresh monetary policy statement. Remember, the monetary policy statements, the MPSs, you get those sort of every second OCR decision, and they're the ones that give you new forecasts. So they allow us to get a lot more information about where the Reserve Bank's heads at, the collective heads, and where they sort of see growth, inflation, and interest rates going. So that'll be an interesting one to watch. The last time we had a MPS was in May, and that was when the Reserve Bank said 5.5% is where we see the peak of the OCR, and we're there already now. So it'll be interesting to look at that August statement and ponder all the things that have changed between May and August, and see essentially if the Reserve Bank still believes that 5.5%, the current level of the OCR, is the top, or whether they believe they might need to do a little bit more work, i.e., raise interest rates further. At the moment, markets don't see any chance of a change in the OCR next month at their August meeting, but market sees a sort of, not quite 50%, but approaching 50% chance of one final increase at the last meeting of the year, which would be in November. So the jury's still out whether the OCR is as high as it goes. The last set of Reserve Bank's forecasts, the last set of forecasts suggests that it is as high as it goes, but some economists think we might go to 5.75, and markets are kind of hedging their bets. So we'll just have to wait and see. Between now and August, there are a few key things to watch. We've had that inflation report, so that's behind us now. We've got the ANZ Business Outlook survey. I think that is next week. So that will be interesting because that will give us a really good forward-looking view of what businesses intend to do with their prices. We'll also get the June quarter labour force report, and this is really important. I think the inflationary outlook really does come down to unemployment and the labour market. Whether you see sort of wage growth slow enough to sort of take the edge off inflation. If you do see the labour market just ease up a little bit, if you see wage pressures come off, then hopefully that means inflation will follow. But if we continue to see strength across the labour market, if wage gains are still coming through thick and fast, that's when the Reserve Bank might have to rethink this view that 5.5% is enough. So lots to watch. Looking ahead in terms of the economic news flow, we'll get the flash PMIs sort of early in the week. They will be out on Monday, and PMIs, that stands for Purchasing Managers Indices, essentially activity indicators. They're very good because we get them very quickly, and they tend to be very up to date. So of all the sort of economic sort of releases out there, PMIs, because they're based on surveys, they're very forward looking, and they give you a really good pulse check of what's happening in terms of the global economy. So we'll get those for Australia and Japan through the Monday trading day at 11 o'clock and 12:30 respectively, and then overnight on Monday they'll follow from Europe, the UK, and the US. So far in recent months they've looked pretty solid, pointing to expansion, although the pace of growth has been slowing. Australia and Europe sort of almost stalled. And we almost saw no growth at all. The UK and Japan better, but still slowing. And the US is one of the strongest parts of the world. The US economy is still very resilient, but we've got some big divergences between the manufacturing sector and the services sector, and that is a little concerning in some ways. So we'll be watching for any developments there. We'll be watching for further indications that inflation is headed in the right direction, and it has been so far. We've seen out of the US, out of Europe, those PMIs have been telling us that inflation will continue to slow, so that's good. So that'll be important earlier in the week. We've also got some important another important inflation report out of the US late in the week. This will be the PCE index, personal consumption expenditures, and this is one of the Fed's preferred inflation measures. We'll get it on Friday. You'd expect it to look similar to what we saw with that that recent CPI release in the US, which is that the headline will fall to a pleasing level. And markets are expecting headline PCE inflation to fall to 3.1%, which will be the lowest since March 2021, more than 2 years ago. So that's good. But the core PCE and the core PCE excludes volatile sectors like energy and food. That's expected to remain quite high, sort of 4.2% at an annual level, which is still the lowest in 21 months, but 4.2 higher than sort of that headline, which is 3.1. So it's not dissimilar to what you're seeing here in New Zealand in terms of the headline coming down, but some of those persistent inflation areas of inflation are still stubbornly high. But that's out on Friday, so we'll be keeping an eye on that. Lots of central banks releasing decisions this week. We've got the Fed in the US, the European Central Bank, and the Bank of Japan. So the Fed will be the major one. It'll definitely be the most important, the most closely watched. Their decision will be out at 6 a.m. Thursday, and then you get a press conference to follow. So we won't get new forecasts, no summary of economic projections at this one, just sort of the statement and commentary and the actual move, if any. And I think there will be a move. The Fed's at 5.25, so they're a little behind us. We're at 5.5. They're at 5.25. So that's the highest since 2007. That's equal with where they got to in the lead up to the GFC. I think you'll get a hike this week. I think you'll get another 0.25%. That'll take the Fed funds rate to 5.5, which would see it above that GFC era peak and actually the highest since 2001. So markets are pretty sure that you'll get that move. So there won't be much of a reaction, even if they do hike rates. But it'll be interesting to see how they talk about the future, because beyond this week, markets are divided about where US interest rates go. The Fed itself has said that there could be another 2 moves from here, so one this week and then one later in the year. That would take their Fed funds rate to 5.75. But financial markets are a little bit cynical about whether we'll actually see that second one. So they're pretty sure you'll get the move this week, but beyond that, they're sort of like, well, we don't know if you'll actually need to do that next one, because inflation's coming down and maybe we'll start to see some economic weakness later in the year. So the Fed will be all about the commentary and the tone. The ECB, that is on Thursday, so that'll be overnight. They'll move as well, highly expected to increase their policy rate by another 0.25%. That would take them to 3.75. Which would be the highest since 2001. They're still playing a bit of catch up. They until July last year, they had a negative interest rate. So it's only been sort of 12 months that they've even been in positive territory. Whereas remember, we started hiking interest rates back in 2021, and the Fed started earlier last year. So still a bit of catch up from the ECB, and I think they'll continue on that path in the days ahead. Japan, no change expected in Japan. They're still expected to remain quite stimulative over the near term. But look, at some point, you would think that you might see Japan start to sort of step away from those extremely relaxed monetary policy settings. Also, what else have we got on the economic front? Closer to home, pretty quiet here, to be honest. We've got the ANZ truckometer. We've got consumer confidence late in the week. Across the Tasman, there's a CPI report, an inflation report for the second quarter. So that'll be interesting. We'll monitor that and see how that looks relative to ours. And beyond that, it'll be all about earnings. Lots going on internationally with the earnings season really ramping up this week. So it's about 20% of the US share market has already reported its results. And so far, it's been pretty good. You've seen the banks, with the exception of Goldman Sachs, which wasn't so great. Been some pretty good results from most of the big US banks. Netflix and Tesla sort of were a little bit disappointing to the market, but on the whole, it's been pretty good so far. And this week, you'll get a lot more companies announcing results. About 165 S&P 500 companies are scheduled to report quarterly results this week, so you'll get lots of news flow. Some of the tech heavyweights due to report: Alphabet, which is the owner of Google, Microsoft, and Meta, the old Facebook. So those three are all reporting this week, and those three alone, their total market value is almost US 5 trillion, and they represent 10 or 12% of the US share market, based on the S&P 500. So they're hugely important. Plus, they've had a cracker year. Alphabet's up 36%, Microsoft is up 43%, Meta is up 145%. So those stocks, like all the tech stocks, have really propelled the market higher this year. So it'll be really interesting to look at those results and see if they can meet those expectations, given that the share prices have moved quite a lot. Won't just be about tech. We've got some of the big oil majors as well: Shell, Chevron, ExxonMobil, lots of the consumer-related stocks from around the world, not just the US: Unilever, Coca-Cola, L'Oreal, McDonald's, Procter & Gamble. So all of those stocks will give us a good read on how the consumer is faring, LVMH as well. Plus, there's plenty of others, 3M, Visa, Boeing, MasterCard, loads and loads of companies reporting results this week, and next week will be the same. So I did record a podcast and write a short report about the US earnings season and what I'm looking for, what I'm expecting. Go and dig that out if you want to know more. In this part of the world, there are a few corporate events to watch across the Tasman. Rio Tinto, the big miner, will release its half-year earnings on Wednesday. Macquarie Group has an AGM, so you might get a trading update there. That's on Thursday. Here in NZ, there's a few AGMs: Mainfreight and Ryman Healthcare, two of the big heavyweights on our market, both got AGMs. So maybe there'll be some guidance about how things are tracking in the new financial year, the current financial year, for those two stocks. Pacific Edge as well. That's obviously one that's had a real roller coaster ride of late. They've got an AGM, so maybe we'll get some news flow from Pacific Edge. But other than that, that's us. There is plenty going on, isn't there, when you think about it? With the PMIs, with the PCE, inflation, three major central bank meetings, including sort of the big one, the Federal Reserve, and truckloads of earnings releases to monitor. So enjoy your week, take care, and we'll talk again soon.
For more insights, visit craigsip.com.